Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get back to the CPI number. So the takeaway in general seems to be that disinflation is not what we've seen, say, in the last 3 months, that what we're used to. But that doesn't necessarily mean that the economy is reaccelerating. So we kind of want to understand the nuance here. Here's Lindsey Piegza, chief economist over at Stifel. She joins us from Minneapolis. Lindsey, how would you categorize the CPI data this morning? And does it change the trajectory at all for the Fed?
Well, I would categorize it as a somewhat disappointing report for the Fed that's still struggling desperately to reinstate price stability. Now, it's important not to look at one data point. That's never enough to sway the Fed in one direction or the other, but we do have to put this in the context of an ongoing lack of even downward momentum in prices. At best, inflation has been uneven, moving sideways for the past couple of months. And so this really underscores the need for the Fed to remain focused on reaching that 2% target. Now, last month, they were buoyed by this mounting concern for the labor market. But as we saw in the latest September labor market data, the employment reports are still near full employment. The data suggests the labor market is still very solid. And so I do think that at this point, the Fed's focus may be better directed towards that price stability component of the dual mandate.
You know, Lindsey, we were talking to Tom Keene and I earlier today with Professor Cam Harvey at Duke University, and he's a big proponent of the Fed's way behind because they're using really dated data, particularly housing data. And if you take a look at some of the real rents and stuff like that, inflation's already whipped, and this Fed should be, cutting rates maybe. How do you feel about that?
Well, I think there's a number of different ways to look at inflation. And sure, if we take out some of the stickiest components, you can get a much better read on inflation. But when we're trying to look at the overall price index for consumers, what we're feeling in terms of costs for goods and services out in the marketplace, that underlying core measure, which excludes food and energy because those are extremely volatile from a policy standpoint, that suggests that inflation is not, quote, whipped, and that the Fed's job of reinstating price stability has not been complete, and remaining on a downward trajectory back to 2% is not a foregone conclusion. So I would caution against that line of thinking. That could leave us in a very difficult position where the Fed takes a more aggressive approach to policy in anticipation of further improvement, only to find out we're not there yet. And the Fed either has to reverse course or simply has driven us into the most unfavorable scenario of stagflation at that point.
But that brings us to the other data point, which is initial jobless claims. I know that they can be volatile. I know you also have a Hurricane Helene as well as the Boeing strike impact. Like, there's those reads too. So which path does the Fed follow? Like inflation slowing less than we thought, or initial jobless claims rising more than we thought?
Well, I think you have to put the jobless claims, as you said, in the context of the events that are occurring in the economy at this point. Between the strikes and the hurricanes, we anticipated a lot of volatility. And you can tell that this is an outsized increase relative to the very calm trend that has been well established for the past couple of years. You also have to put this one weekly data point in the context of, again, that September employment report, where we see wages, we see job vacancies, we see the participation rate, we see top line hiring, all suggesting tight-ish conditions, lingering tight-ish conditions for the labor market, which does not support this pop in weekly jobless claims, again, which is primarily a reflection of some of these one-off incidents in the economy. The Fed knows that. The Fed is not going to adjust policy based on a weekly data point. But again, it does underscore this bifurcation among Fed officials, as we saw in the minutes yesterday. There are a number of Fed officials that are concerned about the labor market and say that we should continue to cut in anticipation of weakness to support the labor market and the broader economy, regardless of what it takes. On the other side, you have Governor Bowman leading the pack saying, no, there's still upside risk to inflation. And that's where we need to keep our focus, because without price stability, the economy doesn't work for anybody.
How about the consumer, Lindsey? Given some of the data points you've seen over the last couple of weeks, what's your read on the U.S. consumer?
Well, I think the consumer is surprisingly resilient at this point. The consumer is still out in the marketplace spending on goods and services, but they're doing so at a noticeably reduced pace. We've gone from double digits to 8 to 6, now down to an average pace of 3. Again, still positive, but a very clear second derivative decline or slower pace of positive expenditures as consumers are feeling the weight of higher prices, higher borrowing costs, the resumption of student debt payments. And so we see consumers increasingly turning to these less organic measures for support in order to keep spending in the marketplace. We see 401k hardship withdrawals up double digits. We see consumers turning to an intergenerational wealth transfer. And of course, surprise, surprise, credit cards are up there on the list.
Yeah, absolutely. All right, Lindsey, thanks a lot. Really appreciate it. I still feel like it's all a Rorschach test at the end of the day. Lindsey Piegza, she joins us from Stifel.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's stay on the Hurricane Milton track. Of course, there were reports of tornadoes also pummeling through the state as well. Let's take a look on the impact on the housing market. Ken Johnson is Walker Family Chair of Real Estate at the University of Mississippi. Ken, it's great to get your perspective on this. How do we know what the full damage is to, say, the housing market? How long does that assessment take?
So we can make some upfront estimations, but we probably won't know the full results, quite honestly, for a couple of years. Using Ian as a test case, we're still recovering. South Florida, that is still recovering. Southwest Florida from Ian. This appears to be less in scope, so we're probably still looking at several months before we've completely gotten rid of Hurricane Milton.
Talk to us about just, I don't know, you think about owning real estate in Florida, boy, that is not for the faint of heart here. Because talk to us just about, I don't know, insurance and how this folks down there just keep rebuilding and rebuilding. Are there lessons learned down there?
Well, many folks predict that these hurricanes are going to end the growth in Florida, and they've been on record for 150 plus years, going back over 100 years. I think there's over 30 Category 3s or higher that have struck the state. Dire predictions have been made in the past, and they never come about, and it's because the demand to live in Florida just keeps increasing. Nice, solid economy, good weather, sans hurricanes, warm in the winter, air conditioning works in the summer, strong business climate. People are coming to Florida, and this is not going to stop.
What about the prices of those particular houses, though? Because what we can't argue is that insurance companies are dumping Florida, right? There's going to be local insurance companies. There are many stories of people's insurance premiums just rising really fast, which means it's hard then to sell the house at the same time. Maybe it's more expensive then to buy a house. Does this need to settle out?
It does, and this has been an issue in Florida for quite some time now. It's slowly getting better. Some legislation was brought about in terms of limiting liability exposure off of certain types of damages, and that you had to be timely in filing your claims. Slowly taking effect. But home insurance is going to be an issue in Florida for years to come. The state does have an insurer of last resort, and that's the Citizens Group. If you're there in Florida, you're very familiar with Citizens. So yes, it's a problem. It's something they'll work through. The reinsurance rates have gone down this year for Florida. That was really good news. Probably will not be again. So in other words, the people insuring the insurance companies, their rates had went down in end of 23. They'll probably be back up end of this year now due to the two storms combined.
All right, let's zoom out a little bit from Florida and just talk about affordability, housing affordability, or lack thereof in this country. Can you just give us a sense of how we got to this place where we are now, where it really seems to be a real stretch for so many Americans, housing affordability?
Sure. So if I had to pick one item that was the most influential in this, or the proximate cause of unaffordable housing at this point in time, was post the last housing crash, circa 2007 and 8, depending on where you were in the country, the the markets turned down, real estate markets all over the country turned down. They bottomed about 12, but during that period in time, we lost thousands of small builders. Today, we mostly have large publicly owned developers. It's hard to keep pace. We've just lost so many builders. The difference between a builder and a developer quite often is maybe the scale. So we have fewer but much larger developers, but we still need those mom and pop builders that build those 50 plus or minus homes a year. And they left the market, or they were forced out, or they were forced into bankruptcy, and they have not come back into the marketplace.
That might be
so we're not building enough units.
Best explanation I've heard for why we don't have enough supply, that nuance. Does that mean then that this is a cyclical industry still, as you say? Like, okay, so then we're gonna overbuild at some point and then prices come down, or is this truly structural?
I think it's still more cyclical, but this is an ongoing issue. So if we go through a few cycles and we haven't solved it, then yes, we have a chronic, persistent problem. I would love to see it a little bit easier for the small builder to develop and thrive and restart. Now, getting that done is another set of circumstances to work through.
One of the issues for a lot of folks is nobody wants to leave their home because so many people are sitting on 3-4% mortgages. Some people below.
You set me up, man.
3.
You do it on purpose at this point. I have 2.75, which I talk about all the time.
All the time. So where do you think mortgage rates need to go, Professor, for the Alix Steeles of the world saying, all right, I can consider selling my existing home and going somewhere else? That would free up some inventory.
So our overall mortgage rates in the country, they're higher. Oddly, they're higher since the Fed's announcement to lower the interbank loan rate. But that'll correct itself in the next few weeks or so. But it's not necessarily what rate will have to come about such that folks will start to begin to sell those 2.75, 3% loans. What will happen, probably more likely for those folks, is they'll have a change in life event. I'm moving to another city. Unfortunately, financial distress will cause a lot of sales. So a lot of these things are going to be brought back. A lot of these properties are going to be brought back into the marketplace because I have to sell rather than I want to sell. But we're probably going to see an environment. We'll get back to the 4.5s, 5s. I don't think in my professional lifetime will we ever see 2.75 or 3% again. That was just so unusual. And we can't have that as the norm. And, we're not back to the norm. Well, that wasn't the norm.
Yeah. I was doing a little happy dance for those of you who were unfortunate enough to
smug.
see that.
Yes.
I am.
There's an air of smugness.
It's the one thing I can brag about, and so I do. When you're talking about it still being a cyclical industry, how long do you think that cycle then could be? Like, when do we get to like an oversupply situation? 10 years? What does it look like?
So hard to say. Again, the cycle, this last cycle has been extended for several reasons, one of which is COVID, and we were talking about the low interest rates. We were pretty near a peak back in 20-ish, and then we had COVID, and we all had much easier access to capital, shortage of housing, we bid prices up. This is going to be quite some time. We're years in the catch-up, so minimum another 3 to 4 years to catch up, maximum a decade.
All right, you just made the big move from Boca Raton, Florida Atlantic University, to Oxford, Mississippi. 30 seconds. What's the big difference?
Well, I have the best of both worlds now. I'm from the South, and I've always loved dreamt of being at a state university flagship school, SEC football and sports. I love Boca, so we've kept a place there in Boca. My wife and I have, and we will continue to be there in the summers and at Christmas time. To me, anything above I-10 is like a reflecting barrier in terms of winter cold. But right. If you come to Oxford, you would understand why I wouldn't pass on this opportunity to come here and build a program.
Yeah, looks good. Fantastic. Ole Miss. Ken Johnson, Walker Family Chair of Real Estate at the University of Mississippi. That is in Oxford, Mississippi. I just kind of Googled mapped that because I kind of always forget where Oxford is. It's the northwestern part of the state. It's very close to Memphis, Tennessee, actually.
Oh, I didn't know
And it's
that.
close to the Arkansas border, but it is, that's deep SEC country, Ole Miss, but pretty cool there. But again, a big move from Boca
Oh, yeah.
to Oxford.
I thought you were looking up an Uber, and I'm like, you're not going anywhere for like 2 hours. So
No,
I don't know what
I'm
this
not-
guy's
no,
doing. But
I'm
now
just looking
I
up-
understand
just,
what you were
seeing
doing.
where it's all about.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's check in with somebody who's paying attention to earnings because they're going to kick off in size tomorrow with J.P. Morgan. We always pay attention to what Jamie Dimon says about the overall economy. Kara Murphy joins us. She's the CIO at Kestra Investment Management. So, Kara, we're going to have earnings tomorrow, but I'd love to just get your thoughts here on that CPI print today and maybe how you think that may impact Fed actions going forward.
Yeah, so given the print today, I don't think there are too many doves who are celebrating. This is definitely a little bit of a fly in the ointment of the deceleration in inflation that we've seen over the last couple of months. That said, it looks like markets are taking it in stride. So, inflation showed up a little bit hotter than what I think many of us would have liked to have seen. And I think it's a really good reminder that the Fed has a tough job. We saw also claims happen to come in today a little bit higher than expected. So what we're seeing now is inflation a little bit hotter than expected, labor market a little bit weaker than expected. So it's a really difficult trajectory. So I think the Fed is still on track to do a 25 bip cut at its next meeting. Today's print won't be enough to really change the Fed's mind, but it does highlight that there's a lot of complexity, and a couple more sort of hotter inflation prints between now and the end of the year could start to slow those Fed rate cuts.
Yep, exactly. We've seen Fed cuts sort of priced out a little bit for 2025. So if we are, okay, it's a twofer. Does that mean that the U.S. economy could reaccelerate? And then if we are seeing a longer economic cycle, does it change where in the market you have to be invest within equities?
I think that's the question that we should be asking ourselves. And I think the easy answer is that, we know that the economy and the market typically doesn't go in a straight line. So the Fed is actively trying to pivot, right? We had our first rate cut in quite a while, and that introduces a lot of cross currents into the market. And so it makes sense that the economy is going to kind of, chunk around for a little bit. So yes, we could see a reacceleration. I think the Fed will then, start to pull back a little bit. But this lag issue in monetary policy is a really big challenge because the labor market starting to weaken a little bit is responding to rate cuts that happened quite some time ago. Rate hikes that happened quite some time ago. So even if the Fed starts to cut, it will be a while before we see it in the market. So it makes sense that the market or the economy will sort of reaccelerate and then slow down again. And it'll take a little while before we get to that firm footing and determine where the Fed should have its resting place be. So then what does the market do in the meantime? I think smaller companies who rely more heavily on debt are a little bit more subject to the Fed's whims. So as Fed rates come down, they'll benefit more. If those rates take longer, it might take longer for them to see that real earnings reacceleration that we're waiting for. But there are multiple different pieces that kind of feed into that.
So given all that background, how are you guys positioned? First, let's go with the equity side of the equation. How are you positioned there?
So we still are really favorable on equities, but what we found is that your core benchmarks have moved very heavy into large cap or mega cap and into growth. So what we're doing is kind of taking a step closer towards a little bit more even split between value and growth and favoring some of those somewhat smaller companies. And I often say, you don't have to go all the way down to small cap in order to benefit from being out of that mega cap. You can just go into the smaller large cap, or we think mid cap is really attractive as well. So just starting to step a little bit towards the center of that while still remaining overweight equities.
Yeah, I feel like I've been talking about mid caps for a bit, and every kind of day you got the S&P making a record high, the mid caps also make a run for it at the same time. Okay, how does that then position you in the bond market? Do we still get a steepener? It's just a matter of how we get that steepener that matters?
Yes, it does. And I think the easier sort of bet to make on the fixed income side is to be out of high yield credit, not completely out, but underweight high yield credit, where we think if the Fed rate cutting cycle takes longer than we'd like to, those are the companies that are going to face some pressure. And you see really low spreads there, right? So you're not being paid a lot in order to take that risk. High quality corporate, on the other hand, we think is pretty attractive. There you get a nice interest rate bump. You're not taking a huge amount of duration risk, but you're still benefiting from that higher overall yield compared to treasuries. So in treasuries there, would be more in the belly of the curve outside those really long duration, which we've seen be fairly volatile as inflation sort of comes and goes, but you want to start to step off of those really short-term rates.
And if I look at the IN-GO function on the Bloomberg terminal, which gives me a nice overview of kind of the fixed income market, year-to-date performance, the best for fixed income has been, and by far, has been U.S. high-yield corporates.
Oh, yeah.
Talk to us about the high-yield market.
I know.
Love to get your thoughts there. What do you think about the high-yield market?
Yeah, so it's been super interesting to see how it's really led. And typically what we see is high yield is very highly correlated with equity markets. So in some ways, that's a lot of what we've been seeing, where it's very consistent that investors are looking for a little bit more risk. And so if they're dipping their toe into the fixed income market, high yield becomes an easy place to go. I also think as folks were worried about kind of the trajectory of the Fed rate cut, that was also a safer place to be. You're a little bit more inoculated from those rate changes because you have that spread. But again, that's looking in the rearview mirror. So we've seen that real strength in the past, and going forward, I don't know that you're being paid to take a lot of that risk.
Yeah, right. Exactly. So then if you want to go in corporate credit, where's the right place? Like you're looking at double Bs, triple Bs kind of thing?
Yeah, I think right in that place. And you can also go higher credit quality as well. Again, those spreads are fairly tight, but if you're in the belly part of the curve, you're a little bit protected from any of that volatility on the long end. And you can have some like really nice juicy yields. If you look at yields today in that space compared to the last 10 years, you have among the best yields that we've seen during some investors' lifetimes. So that's a pretty attractive place to be.
And Kara, I think the month of September was either the biggest issuance month, or one of the biggest issuance months of investment-grade corporates. When you as an investor see companies rushing to the market, what does that tell you about the market? Do you take anything away from that?
Well, I think a lot of firms had really held off issuing debt because of uncertainty in the markets and uncertainty of where rates were going to go. So I think this is a sign of confidence that people are willing to come back to the market. I would expect to continue to see issuance kind of tick up over the next couple of months, especially if we see additional rate cuts. So I think it's a healthy sign for the market overall.
All right, Kara, really appreciate it. Thank you so very much for joining us. Kara Murphy, CIO at Kestra Investment Management. It all depends, too, Paul, like what do you think the catalyst is going to be? Deutsche Bank had a really interesting note out, and I appreciate it is from the equity side, but saying that cyclical growth is now the key driver for equities, not inflation, not rates, which makes earnings season kind of all the much more important. Sure, maybe you're all talking your book of what you like to cover, but the idea is like, look, the Fed's going to do the thing. Other things are going to matter, especially if we get any sort of CapEx spend after the U.S. election, or even after earnings, for example, and some of that's going to be structural rather than cyclical. Yeah,
be interesting to see. And I guess, Jamie Dimon tomorrow, I think a lot of folks kind of really dial into that call, hoping to get a view of kind of how the global economy is looking across all of their businesses. But again, maybe it could be a time for cyclicals. A lot of folks, as Kara was suggesting, maybe thinking about broadening out this market a little bit in mid-cap and small-cap. So keep that in mind.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we want to get the take now on what Hurricane Milton means for the reinsurers and the insurance companies. Matthew Palazola, Bloomberg Intelligence Senior Analyst, P&C Insurance, joins us now. So how have you changed your modeling in terms of the impact for the insurers based on what we've seen?
So it looks like they avoided the worst case scenario. We were talking about going into the storm, the industry was talking about $100 billion worth of insured losses, which would have made it the worst storm ever. That was predicated on a direct hit into Tampa Bay, which really didn't happen. So that was the good news. The bad news is it's still going to be a large insured loss event. Now, the other good news for the large national carriers, we kind of talked about this before, is they're just not big players in that market. So companies like Travelers, Chubb, AIG, Hartford, they're not major players in the Florida home market. They will have losses from this, but much less than we initially anticipated. I come to like a midpoint of maybe 5 to 6% of annual EPS taken out from the storm.
What do we think the insured losses actually will end up being, if not $100 billion?
So it's super early, Paul, but I mean, just back of the envelope, we're kind of looking at maybe 10 to 50 or something like that. Like, it could be on top. Hurricane Ian 2022 was 65. The early reports I'm hearing is the surge in Tampa was actually less than even Helene. Right. So it was less than Ian as well. So it could be lower than that 65, but it's still early, and you've got the Helene damage on top of it.
So how does it work then with premiums? I mean, we're used to hurricanes, right? So like, do premiums for insurers or reinsurers wind up going up? Like, how does that work, and what's the immediate reaction?
So you got a bunch of dynamics in this. Home insurance premiums going up anyway, right?
For everyone?
Pretty much for everyone. That's been happening for a while now, and that is cost of materials, the frequency and severity of storms nationwide anyway. Severe convective storms, kind of strong hail, stuff like that. So it's not just hurricanes. So that has been driving home insurance prices up anyway. Reinsurance prices of insurance for insurance companies have been going up anyway, which drives it up as well. What I think will happen, and I don't exactly want to make this call, but there's going to be demand surge, meaning there's going to be a huge demand for building materials, and that is going to push up costs across the country as well. So that'll feed into price. So there's a bunch of upward things pushing on home insurance prices.
I don't know. It just feels like we've had a lot of storms, and I know this season was actually pretty calm until just recently. Then I go look at the S&P 500 Property and Casualty Insurance Sub-Industry Index, and there is such a thing on the Bloomberg terminal. It's up 38% year to date. These insurance stocks are doing well. What's going on there? What's the call?
Fundamentals still good for them. And we expected a busy hurricane season. Kind of new conditions were conducive to that happening. And there was a lot of formation. There weren't a lot of big landfalls. But these stocks, they're defensive. So it's like kind of when you get worried about the economy, they do okay. But then they can also benefit from the economy. So they're a nice play on both of those things. Interest rates going down is less of an impact on them than other financials. It's not great for them. It helped them a lot. But if you have to own financials, they're less sensitive to interest rate moves. So there's a bunch of positives there. I see fundamentals probably peaking. So, we might be at that point, but still good fundamentals.
This might be a really silly question, but did the insurance policies just for homeowners or even small businesses, do they insure the right things for the type of weather pattern changes that we're seeing?
Ooh, good question. So,
thanks.
Yeah.
Okay. I thought it was kind of a silly one.
Well, here's the thing is that they do. So they step back. The home insurance industry, it's not like they're raking in profits. It's not like, there's a big flood and we didn't have to pay for it and we're making a lot of money. We look back, so over the past 10 years, the industry has paid out $1.03 for every dollar they've taken in. And that's in losses and expenses. And that's even excluding, storm surge and flood. So it's not an incredibly profitable business to be in anyway. So if you were to say, okay, now these guys have to insure flood, they have to insure storm surge, then the prices of these policies would need to double. So to answer your question, Alex, they're not, but for them to insure everything they need to would be prohibitively expensive.
It's sort of like how I wouldn't have wildfire insurance for a New York apartment, but then we had all that wildfire smoke. Like, if that becomes like a common occurrence and it messes up with, I don't know, whatever things you have in your house or apartment, like, that's different. Anyway, I think.
Did Warren Buffett go into the Florida insurance market in the last several years, and was that a mistake with hindsight?
So, Berkshire has obviously vast insurance businesses. Geico's a big auto insurance writer in Florida. In 2023, they made a big bet on the Florida reinsurance market. And that paid off handsomely for them. Okay. They could have lost a lot there, but it actually worked out well. We would have to hear from them, but it appears that they kind of completely backed off of that market this year, which turns out to be another good idea. So they'll have losses in there, no doubt. It will not be anywhere near the magnitude that it would impact another insurance company with a smaller balance sheet. So they'll have some losses from this, but last year they made a big bet on Florida that paid off. This year, pulling out that big bet was beneficial.
I didn't know insurance companies could go in and out of markets so quickly.
So in the reinsurance market is easier, right?
Okay.
Like they can reprice on an annual, they can all reprice on an annual basis, but there's less regulation in that market. So they can write or not, anywhere in the world, kind of where they want to.
All right, Matt, thanks a lot. Really appreciate it. Matthew Palazola, Bloomberg Intelligence, Senior Analyst, P&C Insurance. We didn't even get to the cat bond market, but apparently there were estimates that those catastrophic bonds would lose as much as 15%, and now that's been repriced as well. So now maybe we're in single-digit losses for that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney live here in our Bloomberg Interactive Brokers studio in New York City. We're streaming live on YouTube as well. Bloomberg Radio Live. That's kind of where you can find us there when you search. I tell you what, in the world of M&A, I'm not sure I'd want to be a banker today. Maybe an M&A lawyer is something. That would be, I think I could bill by the hour and get paid.
Or antitrust lawyer.
Antitrust lawyer, boom. Because this FTC is no joke under President Biden. Lina Khan, who heads this Federal Trade Commission, she is tough, and she is the subject of our Big Take story today. Lina Khan has plenty more targets if she gets another term. Joining us is Max Chafkin. He's a senior reporter for Bloomberg Businessweek, and the story does appear in Bloomberg Businessweek this week. It's his co-authors, Josh Idelson. Max Chafkin's with us here. Max, talk to us about Lina Khan. Who is she, and how does she view the FTC as perhaps a check on consolidation in a number of industries?
Yeah, Lina Khan's a really interesting figure in the Biden administration, but also as a political figure today. She's very young. She's the youngest ever FTC chair at age 35. She also, she's sometimes described as an academic, but her academic career was very brief. She basically went almost straight from law school to this position, and she became kind of famous for writing this article in 2017 arguing that regulators need to look at antitrust differently, in particular in relation to Amazon. So in the past, most people said, hey, if prices are going down, that's good for consumers. No need to worry about it. Lina Khan argued in this paper that there are other costs of having Amazon dominate so many industries. Cost to businesses, other smaller businesses, cost to labor, and maybe ultimately cost to consumers. And that view has kind of powered this new movement that has scrutinized a lot of the big tech companies. We've seen antitrust actions against, Google and Apple and Amazon, and as well as you're saying, a level of scrutiny on mergers that feels new, that feels somewhat different from the past. That's
so interesting. I love the way you phrase that. So we usually think about it as, does it hurt consumers? And now we're thinking about hurting in a much broader sense. So if we get a Harris or Trump, well, we're going to get one of them. So does that change? Because one can make an argument that I'm sure Wall Street is pressing the Harris camp to also have changes at the FTC.
Yeah, my co-writer on this, Josh Idelson, and I spent a lot of time talking to various, donor types and people who are pushing for various things. And what you learn is that the people who seem to be most vocal right now are sort of centrist Democrats and centrist Republicans. Both of those groups, the kind of who represent sort of what you might think of as like the normal kind of corporate consensus, the way that a lot of people thought about how government should relate to business over the last 40 years or so. They all are kind of against Lina Khan in one way or another. You've seen a lot of very angry Silicon Valley types saying that she's, destroying M&A, destroying the venture capital industry, and so on. And you're seeing that kind of thing from sort of Chamber of Commerce Republican types. Now, where you see support is kind of the squad, the sort of progressive left that likes Lina Khan because she's pro-union. There's also some support from some corners of Silicon Valley, the parts of Silicon Valley that maybe are mad about Google and Amazon being so dominant. And then on the right, you actually see support as well, because sort of like the Trumpist right, the MAGA right, J.D. Vance types, the sort of young Trump supporters who tend to be really mad about tech dominance and also have somewhat populist views on business and on how government should relate to business.
Do we have any idea how Vice President Harris feels about Lina Khan in this FTC?
She has been studiously vague, I would say.
Yeah.
I think the closest sign we have is the price gouging proposal, because Harris announced that she was going to have the FTC crack down on price gouging by grocery stores. That would be an expansion of the FTC's authority. We asked Lina Khan about this, and her answer was somewhat careful and political, but essentially was like, "Hey, I'm open to it." And she made clear, she would like to serve another term. She feels there is a lot of work to be done, and you've seen over the last few months the FTC has been very active. I think they will continue to be very active.
We heard Jamie Dimon speak with Lisa Bromwich earlier this week, CEO of JP Morgan, very much again saying he thinks that CEOs should have a seat at the table, that like half the cabinet should be, probably overdid it, but half the cabinet should be CEOs. And so I'm just wondering how that plays in to an FTC that is more aggressive against company mergers. Like, will there be a relationship to be had?
The most interesting thing to me about the Biden administration has been in years past, I typically cover Silicon Valley, and when Silicon Valley would say, this person is anti-tech, this politician anti-tech, that would provoke a reaction because no politician wants to be seen as anti-tech or hasn't been. And the difference with Biden, and I think to some extent the difference with Trump, is both of them have been comfortable with that. They say, you want to be mad at me, billionaires? Okay. That's good politics. I'm a populist. People tend to like that. And we actually heard that, and there's some quotes in this story to this effect, like, Reid Hoffman speaking out against Lina Khan. There are people on the left who think he is doing Lina Khan a huge favor because he's going to make it very hard politically to fire her. And I think this position, the position you're hearing from Jamie Dimon and from lots of people in kind of the centrist, kind of traditional, corporate roles, I don't know how popular it is politically. The ideas that are on the ascent are really populist ideas, and you're seeing that on both sides.
And it's not just Lina Khan. You look at the Department of Justice, you report in your piece here, they're taking a tough rule against Google, for example. Apple, SEC Chairman Gary Gensler pushing back on crypto. So this is not just a Lina Khan thing.
No, absolutely not. And I think, Jonathan Cantor, who's the head of Antitrust at the DOJ, Gary Gensler, you said SEC. Lina Khan has come to symbolize something. And I think that it's partly because of her youth and because of who she is and where she comes from. She's not a conventional Washington figure in any way. And also because you get this attitude that she doesn't care. And that can rub people the wrong way, and I think it does rub people the wrong way. When you talk to business people, they are mad about policy, but they are also mad about tone, and I think that is some of what they're reacting to. But of course, that has a political upside. We saw yesterday AOC coming out really swinging in favor of Lina Khan after Mark Cuban made some comments. He made some similar comments to us that we put in our story, but essentially criticizing Lina Khan. AOC saying it's going to be an all-out brawl if you want to. If anyone wants to remove her. So I think this will be an interesting political issue, whoever is elected in November.
All right, Max, thanks a lot. Really appreciate it. Max Chafkin, Bloomberg Businessweek Senior Reporter. This is the Big Take piece. You can check it out on Bloomberg Businessweek and also Big Take on the Bloomberg Terminal. Really good stuff. It's going to be so fascinating. And if you're a CEO, do you want to get into the M&A line and just kind of wait there? Or do you want to wait and see what happens after November and what happens to Lina Khan? Like, what's your strategy,
Yeah, it seems like we talked to Jen Rhee, who's an antitrust analyst at Bloomberg Intelligence, seemingly almost every week about every deal that gets announced. We got to go to Jen Rhee and say, are these regulators going to let this thing go?
Who's busier, George Ferguson or Jen Rhee?
Exactly.
I don't know. I think it's a toss-up at this point.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We bring you all the top news, not about lice or Amazon, but other stuff too, through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies, 130 industries around the world. Tim Craighead joins us now from Bloomberg Intelligence. He's Global Chief Content Officer. He has his eyes on everything. And they have a great note out that talks about 10 companies to watch in the fourth quarter. All right. Can you pick your favorite? Like, I have ones I want to ask you about, Tim, but you pick your favorite and let's start there.
Well, you guys are talking to your bartender and your Amazon driver. You're going to do that after you visit Trulieve, even better.
All right, so what's that company and why?
So, just to put context, this list of 10 are all focus ideas of ours. So companies where we have a high conviction view that we think is different from what the market thinks, and there's catalyst ahead. TrueLeave is a marijuana grower and distributor. They have stores, 70% of their stores are in Florida. And Florida has on the referendum this November the potential for legalization for recreational use. It would be a big deal for TrueLeave if this were to come through.
Yeah, I mean, Florida, huge market. And you know what I recognized when we went over to Ireland a couple weeks ago? They don't do the gummy thing over there. They don't have the weed thing.
Really?
They gotta get on board there.
They just go to Amsterdam. Maybe that's it. Maybe they don't really need to. They can't compete.
I'll get Tim on that.
They just go to New York and then they come back to Ireland.
Exactly. Antisports. Talk to us about that, because I feel like I know they're an Asian company, so I'm assuming this has a China call to it?
It does, with an interesting twist. Anta is a sportswear company. They have a number of brands. I think when I've been on your show before, you may have seen that I've had an Arc'teryx vest on.
Well, you're like one of those. Tim is like an extreme biker, climber, hiker, all the stuff that I just have no interest in.
Good for you, Jim. I got nothing on that.
But
no,
Arc'teryx is owned by Anta, but the reason why Anta is on here is twofold. Number one, they do have a lot of things going on from the standpoint of driving their business with various brands. And the Olympics play through. We'll get results when they report next in terms of how good it's been. The China national team wore Anta Sports kit. But it's also a case you've seen lots of news about Adidas and Nike and how they're trying to get their inventory under control. That's making pricing better for sportswear generally, and we think that that's playing through into Anta Sports margins as a corollary.
That's interesting, especially when you compare it to, like, say, Nike. I understand they do different things, but still. You have Alstom on here. So this is basically straight up railroad stock. Why do you guys like this one?
Well, there's two things here. If you were to look at a 3-year, 5-year type chart, you would see that this company has gone through some problems. They had a big write-off and problem that was announced a year or so ago. The stock had collapsed. That's been settled, and they're on the right track, no pun intended, at this point. But importantly, there is a new European Union-wide signaling system that's coming into place that is meant to be reducing a lot of complication between different countries and whatnot. And it's an Alstom system. And in general, the train business is running pretty well. We think they're on a road for recovery.
Tim, the biggest or one of the bigger market cap names on your list is Saudi National Bank. And I'll start with, I know nothing about Saudi National Bank, but it's 57 billion market cap. What's the story there?
Yeah, it's really interesting. And this is true for Saudi National Bank. It's also true for some others in the country. It's running contra to what most banks are experiencing. I think there's been lots of news and coverage, and certainly we've written about the pressure coming ahead for most banks with their net interest margins as interest rates start to decline. Their loan pricing comes down, and that's not great for margins. Saudi National Bank is an interesting case where, given the nature of how their loans reprice versus their deposits repricing, they actually stand to see over the course of the next 6 to 12 months net interest margin growth and expansion. And so it's running counter, given just simply the nature of their asset and liability mix, to normal bank profitability in the current cycle we're in. So it's a really unusual story.
Okay, we got like a minute. Can you do First Solar for me? Because for me, that's a TBD based on what happens with the Inflation Reduction Act here in the U.S. But you tell me.
It absolutely is. I mean, we all know that the election coming up is going to have a lot of implications for what happens from energy transition related spending and whatnot. That said, we're still going to see solar panels as a renewable energy source continue to grow. These guys are in the catbird seat, so to speak, from the standpoint of they have a dominant position in the US. They've got good technology, even though the Chinese producers are bigger and lower cost with arguably better technology. There's way too many restrictions for China product to come into the States. And so for solar, is not, you wouldn't say it's in a monopoly position, but it's a very advantaged position. And almost regardless of what happens with the IRA, we think that they've got wind at their back for better order growth going ahead.
All right, Tim, thanks a lot. Super appreciate it. Tim Craighead. We're going to get you back because we got through, what, 5?
Yeah, we got to get him back into New York. We need to get him to New York.
That's
he needs
true,
to hop
too.
on a plane.
But Mark, let's get him back. We'll do the other 5. All right, Tim Craighead, Bloomberg Intelligence, a Global Chief Content Officer, joining us there on companies to watch in the fourth quarter.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.